Hey everybody, it's Daniel here from Infrares. Hope you're all doing well. It's been a while since I did a video, but lots to talk about when it comes to the economy, the markets, what to expect. We had also Jerome Powell come out in the FOMC meeting, and also yesterday come out, uh, lay out a few couple of comments as well. I'm going to go over that. But let's first talk about what happened with the last FOMC meeting that we had, where the Fed, the head of the U.S. Central Bank, came out and did a 50 basis point rate cut. Right, so we got a 50 basis point rate cut in the U.S., and that basically caused stocks and bonds to initially go up, and we saw a nice rally in both those asset classes. And that rally was a little bit short lived on that day, and followed by we had a sell off afterwards. And it was basically on the back of that the 50 basis points was somewhat priced in, it was expected. And, looking at also the projections, it didn't hint towards further aggressive, more aggressive rate cuts, where the equity markets were basically waiting for, hoping for. So we got that move. We got the 50 basis point rate cut. We have we had Jerome Powell come out and other Fed members come out talk about that. They're starting to cut rates. They believe that if everything goes as is, inflation doesn't pick up, although shelter component of the inflation remains to be sticky, but basically calling it that they've won on inflation, and that as this trend continues to be the same, we would probably see continuous rate cuts for the year and also next year. So fast forward, after that we had China come out and also do aggressive rate cuts, followed by also injecting liquidity and pumping money in the overnight session, which caused equities to move up during the overnight session. China basically talked about that they're going to pump in, I believe it's around a trillion yuan into the markets, which basically caused a lot of the Chinese stocks like JD.com, Baba, right, the Yin ETF, a lot of the Chinese stocks basically to rally aggressively on that news. And you also had other central banks around the same time, come out more on the dovish side of things, cutting rates and so forth, right? Yesterday we had Powell come out, and we had a little bit of a sell-off in the equity markets when Powell came out, because he basically laid out saying that this projection that the traders have of these aggressive rate cuts basically throw cold water on that, because the markets were pricing in that November, we're going to see another 50 basis point rate cut, and the markets were basically pricing in about a 60% or higher than 60% chance of that happening. But Powell came out and basically threw cold water on that, and now we see those probabilities drop lower, basically saying that they're going to follow their projections, which they penciled in, a 25 basis points for November, and then another 25 basis points in December. We also had the Wall Street Journal news reporter, who's famous, known as Nikki Leaks, also come out and talk about that. There's a general consensus at the Fed that they're not going to be so aggressive with the rate cuts this year, unless obviously something drastic happens. So that meaning that 50 basis points rate cut for the year was a one-time thing, and they're going to go with the rate cuts slowly. And that's expected. That is not a surprise for me. although the markets were expecting 50 basis points in November, and when they got the news from Powell's, throwing cold water that, hey, we intend to go as planned, as seen in the projections, if everything remains the same and nothing changes, and basically talk about that, the economy is doing fine, and basically giving soft landish vibes. So the equity markets and the bond markets both sold off on that. But then later in the day, we saw the equity markets just squeeze up higher and rally aggressively right at the end of the day. And again, you're getting rate cuts, right? So what is there to be so disappointed about in the equity markets world? Whether it's 50 basis, 25 basis points, right? If you're seeing, we're going to get data actually this week, non-farm payrolls and so on. But if you're seeing the data so far, you may argue that you're getting rate cuts along with soft landish type of data, nothing's breaking, so forth and so forth, and that's why we're seeing the equity markets rally. In fact, the Dow Jones made all-time highs. It's down from that now, just about 2 days back, and and we see all the other equity indices also very close to all-time highs. S&P 500, NASDAQ, and so forth. So, the idea of the 50 basis point rate cut coming again wouldn't come unless there's something drastic that happens in terms of the labor market. It gets weaker in terms of the economy getting weaker. Then you would, yes, see the 50 basis points or more, or potentially those emergency rate cuts that would then come in. So, what does this mean in terms of the markets, in terms of the economy, in terms of where things are headed towards? Well, it simply means that just like in history, what we've seen back in 2007, it starts with these slow rate cuts, which they're doing. They don't want to reignite inflation, especially with this new geopolitical tensions, war escalating. You have oil picking back up again. Especially today, and you have elections coming up as well, creating all these uncertainty. Jerome Powell and the Fed want to be careful with how they go about cutting rates and not doing it too aggressively to make sure that they don't reignite inflation. On the other hand, you have other central banks around the world stimulating, providing liquidity, like China. And in the overnight session, you see the futures market and the S&P 500 and the equity markets show strength and rally, right? Now, that could also support the equity market during the North American hours, especially because you've got those rate cuts from the Fed, continuous rate cuts from the Fed, and also potential of maybe liquidity coming in from the U.S. Central Bank as well. And you're starting to see that a little bit of that support from the Fed. So we're moving into the regime of the rate cut cycle, into the pumping of money soon, into supporting the markets, the equity markets, the economy. But it's not going to be as aggressive as the markets might be pricing in, or some people may be expecting. It's going to be slow, and it's going to be more broader based, more long term, more spaced out. And in terms of those aggressive cuts, that would only come until something truly starts to break, like that labor market. So that's what I'm watching for in 2025, is how does the labor market play out. That's what I'm watching for also this week and the coming months, as the new data and new information comes out. How does the growth data and the economic data play out? And according to that, you can dictate whether the Fed's going to be aggressive in terms of cutting rates or not. The only question I have is cutting rates enough, right? And sure, this may temporarily spur the equity markets to continue to rally. I would not be surprised to see the S&P 500 reach close to 6,000 or go above 6,000 on this rate cut kind of fiasco. But I wouldn't be surprised if we see that run up, that melt up, followed by a plunge because something's breaking and those rate cuts are not enough. When you look back in 2007, 2008, when they really started to introduce this money printing and QE and liquidity pumping, back then, before 2007, rate cuts was a big thing. But in 2007, when they were cutting rates, in 2008, they were cutting rates, the equity markets was still plunging. You still had the equity markets crash, right? So, meaning that those rate cuts, they have a delay effect in the real economy and also in the sentiment in the equity markets. It didn't really do the job or save the day. What really saved the day was that money printing, the QE. That's what's important. If you saw during COVID time, the amount of stimulus and the money that was pumped into the equity markets is what saved the day and caused the equity markets and all these asset prices to go up higher. That's what I feel would be somewhat similar, the same playbook we could see in 2025. Those rate cuts come in. If something disastrous happens, then we see a turnaround in the equity markets. Equity markets start selling off. They do emergency rate cuts. Maybe it props the market a bit temporarily, but then we go back to selling off aggressively again. And it's until you get that money printer to start again, an injection of trillions of dollars back in the system, is where you could see that floor, that bottom, and the equity markets to rally, right? Everyone's got this, the traders and investors out there have this mentality. If you look at the psychology, that as soon as you talk about money printing, you have the sentiment completely change. And even if it takes time in the real economy to show up in the equity markets, you get this bullish sentiment once the money printer goes burr. And you saw that with China. Once the money printer went burr, you saw a lot of these Chinese stocks aggressively went up, right? They were cutting rates before. The Chinese equity markets were still selling off. They were cutting rates, still selling off, still selling off. It wasn't doing anything. I suspect something similar with the U.S. markets as well, if there were to be a hard landing, sort of a black swan event or crash or whatever that spooks the equity markets. You would then need Jerome Powell, Papa Powell to come out and start the money printer, and that would save the day. The worst case scenario is, this is not my base case, but I'm going to throw it out there, is that in 2007, 2008, the money printer, the QE idea was basically, there was a lot of negative light around it saying that it wouldn't help, but it ended up actually working and helping. What would be, curious for me to see is that, could we see a scenario where this time the money printer fails? Again, this is a super bearish argument. This could be like a 1929 depression kind of style event. I'm not making this my base case. I'm not saying it's going to happen. But it would be interesting to see that if they start the money printer, and if they're not printing that much, could it still cause that bearish action in the equity markets, not causing it to go up? Or worst case scenario, they print a lot, but the bond market is imploding, the US dollar is imploding, everything's crashing, the equity markets are throwing a tantrum, and it still sells off. Again, not my base case. I'm not saying this is going to happen, but an argument that some of the super bears out there are, maybe talking about, that this could be that 1929 massive depression, 80% crash in the equity markets. I don't see that. I'm more of aligned with you get that hard landing. Fed comes to save the day. Money printer goes brrrr. They print trillions. Inflation comes back again, roaring. Equity prices, asset prices, roaring again, and the cycle repeats. Rinse and repeat. Rinse and repeat. Rinse and repeat. So that's my thoughts for everything that's been going on with the rate cuts that we've been seeing. This is just the start. We can expect slower rate cuts followed by, again, watch the data, watch the employment data, especially post elections, right? 2025. That's what I want to see. As long as the data is not manipulated, then we can see, the weakness start to show up, especially next year, and then how Jerome Powell reacts to that situation. And then I believe you're going to start to hear again those 50 basis points, 75 basis point rate cuts. But until then, I don't think you're going to see that unless, again, something happens from now until December. Until then, we'll see what happens. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers. Bye.